Well, the FOMC minutes came and went, and we did not learn a whole lot more than we thought. And so far, so good, supposedly. But stocks do need a new catalyst, and perhaps one place where there could be a place to look is outside of the US, because we do, of course, have a very quiet week this week. So that's what we're going to do here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to do here is consider if we have a little bit of help on the way after some interesting economic data that we saw coming out of China over the past 24 hours, and consider what comes at us downwind, because there is quite a bit more from the world's second largest economy that we're going to hear through the weekend here and into next week. And on that, give perhaps a little bit of context and a little bit of background for the way in which the overall global landscape might be shaping up here. And with that, of course, back our way into a conversation about stocks and the sort of larger impetus for U.S. markets and what all of this might ultimately mean. So let's begin here with a look at what exactly is on the menu here. First, of course, the view of inflation that we just saw over the past 24 hours. And we can see here that we get a little bit of a wiggle higher after 4 months in negative territory on the consumer price index. In fact, it's a little bit stronger than expected, 0.1% month or year on year rather. And it's not, of course, a potent rise in inflation, but you do have to start somewhere. And you could make the argument that there's perhaps a little bit of a semblance of demand returning. China has been a story of anemic inflation for quite a while, as we can see here. But maybe this is a green shoot. And then we look at the data that came alongside, and those types of hopes seem to evaporate. The month-on-month number, 0.1% on the downside. In fact, we've only seen 2 increases in inflation out of the past 6 months. 4 of them have been on the negative, so the dynamics here are not especially encouraging. And then if we look at the level for China's CPI, this is not year-on-year rates, this is the actual index. We can see it's been locked in, give or take, a 1% up and down range here, oscillating for over 2 years. And so this 0.1% increase that we see here looks more like statistical mirage than it does anything that's extrapolating. It appears to be more about a sort of return to average, a kind of retrenchment back toward the mean, rather than in the year-on-year numbers, that is, rather than a something that might suggest there is a build higher in the works. And so when we look at the overall story, it seems like we haven't gone much of anywhere, just saw some statistical rebasing in the numbers rather than marked any kind of a meaningful improvement. Moreover, if we look at wholesale inflation, we actually get the steepest deflation here at 3.6% year over year that we've seen since July of 2023. So again, almost 2 years. Moreover, the pace of disinflation has been or deflation rather, has been very steady here for a 4th consecutive month. PPI is down 0.4% month on month. Now, first of all, that's a step deeper into negative territory as compared to the preceding 4 or 5 months. But more importantly, perhaps, what this is a very steady pace that's taking us further and further into negative territory since the beginning of the year. And of course, what all of this suggests is ebbing demand. When prices rise, that is because there is more demand for a given supply of goods at a given point in time, and that bids up costs. That speaks to demand. Economic growth and inflation go hand in hand typically for this reason. But when you have the opposite, especially here, very tellingly in wholesale inflation, so pipeline inflation before it gets to consumers, what you see is waning since the beginning of the year. That speaks to eroding price pressure and, in fact, backsliding in the opposite direction when it comes to demand. This is prices being cut. This is discounting. And discounting speaks to an absence of demand and is aimed at attempting to spur that demand with lower prices. So when we see this slight wiggle in CPI on the upside, it's tempting to say that this is demand. But when you see this occurring at the wholesale level, and this, the story for essentially 2 years' time here, more, it really doesn't strike as the plausible explanation that we're finally seeing signs of life in China's economy. And indeed, last week, the PMI numbers that we saw echoed the same story. This is the official set of numbers from CFLP and NBS. We can see here we're hugging the 50 line on these PMIs. Of course, as ever, 50 is neutral in the logic of PMIs. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here is we're basically hugging 50 now for about a year and a half, and increasingly closing in on just oscillating around that level. We're a touch higher than that on the composite, as we can see here, but only just a bit, suggesting the economy is near standstill. It's growing, but very slowly. It's a similar story when we look at the Caixin and S&P Global version of this data. It's a little bit headier in the sense that we're a little bit above 51 on the composite index, whereas we're not quite there on the government version of the data. And in general, we can see this is a little bit more volatile. We saw this decline sub 50 in the prior month. Now we've overshot a little bit into the low 51s, but the trend here is unmistakable. And again, we're hugging that 50 level right down the middle here. And the trend has certainly been lower into it. So economic activity here not looking great and not really going very far. That sets us up for a very interesting set of numbers incoming. We now are looking at these import-export numbers due over the weekend. That'll be a very interesting part of trying to discern where the front-running of the tariffs with the U.S. has hit a wall, and the weakness of domestic demand once again starts to overshadow much of anything else. We're going to have a funding data over the weekend into Monday, and then this is, of course, Sunday in U.S. terms, Monday in China terms. And then midweek, we're looking at a first look at second quarter GDP, where it looks like we might see a meaningful slowdown if all of these numbers hold up and all of this type of front running really has run its course and was mostly a story about the end of last year and the first quarter of this year, as of course we saw with such great effect in U.S. GDP statistics and their massive surge in imports and in inventories in the first quarter. Now, the trend would bear that out. Exports for China have been slowing for 3 consecutive months, or 2 consecutive months from the peak 3 months ago, to be exactly accurate. So it does look like you got this surge around the front running of the tariffs at the start of the year, and since you've kind of fallen back to where average was, going back to, let's say, late 2023, start of 2024. And of course, moreover, for imports, we've yet to see an increase in imports for China this year. All of the numbers so far this year have been versions of negative, which really tells you just how anemic domestic demand looks. And so with that in mind, we're looking at a situation here where it seems to be that the overall sort of picture hasn't really improved in any kind of a material way from where China has been over recent quarters. And that doesn't paint a very encouraging story as we get into the second quarter GDP numbers next week. This is a view of China's GDP numbers, nominal relative to real. This is a chart we come back to over and over again as we assess what's going on here. And the main takeaway here is that real GDP is running above nominal. Now, nominal GDP is the value of all the goods and services produced in the economy without taking out the influence of prices. So that includes inflation. To get a sense of what the value is outside of inflation, you subtract that inflation and get real GDP. So when you take the difference between real and nominal GDP, you get a sense of what that inflation coefficient is, economy-wide. And what we see here then is when real GDP runs north of nominal, that means that to get from nominal to real, you have to subtract inflation. That is to say, nominal only gets you higher real if you add to real negative inflation to bring it down to nominal. Or alternatively, take nominal and subtract from it negative inflation, which you can see there's the spread right here. And what this is telling us is that for 8 consecutive quarters at an economy-wide level, prices have been falling in China to the tune of close to 1% of GDP, which is staggering and speaks to a near total absence of demand. Consider how this stacks up with the COVID recession and how shallow of a baby negative reading you get right here. And then consider that for 2 years now, China has been mired in a deflationary spiral that basically speaks to the entire economy having been relegated to the discount bin. There's overwhelming overcapacity relative to demand. Now, we have, of course, seen a tremendous amount of stimulus efforts come out of China, and perhaps they're starting to bear fruit to some extent. We are seeing a rise, finally, over the past 2 months, in the share of new loans in GDP. That's what this credit impulse index is. It is a ratio that measures new loans as a share of overall output. And of course, we've seen that only in the past 2 months has this finally started to perk up. But is it in fact as positive as it looks? Are we actually seeing this money getting deployed to drive demand? And again, looking as we like to do at household bank deposits, the story appears to be no, because the spread between demand deposits, essentially checking account equivalents that are there to be spent, that are callable instantly, essentially the same as cash, and time or demand deposits, essentially savings accounts that are sort of in the realm of CDs, where you put money away and lock it up and set it aside. So money that isn't earmarked for immediate consumption. We see there that the spread in favor of savings accounts versus essentially checking or demand deposits is absolutely surging. Here are these time deposits. Here's demand deposits. This is the biggest disparity of this kind as far back as the data goes. And so perhaps, yes, people are lapping up all of the cheap money that Beijing has made available, reasonably enough, of course, but it doesn't look like anybody actually has confidence to consume anything. And they're stashing the money because they expect some sort of adverse outcome downwind, or at least want to be insured against one with as much dry powder as they can be. And this, of course, is where we circle back to the overall global story that then is implied in looking at all of this. And this comes, once again, from the PMI world, and it's a chart that should be familiar by and large, but of course now we have it fully updated for the month of June. And this is comparing the composite PMI numbers for the US, the Eurozone, and the two versions out of China. Now, here we can see, here's those composite PMI numbers. For China, as we said, the official number is 50.7, Caixin 51.3. So they're just north of standstill, but we can see they've been hugging that standstill really for at least a year, but going back easily to where the economy basically landed after the reopening from COVID restrictions in late 2022, going into the beginning of 2023. Soon as that COVID rush ran its course and everybody essentially came out of lockdown and all that pent-up demand had its splash, we've essentially slumped back to anchored at essentially barely any growth at all. The Eurozone is in an even dicier spot here, though the latest PMI at 50.2 puts them effectively at standstill. And so the only real growth in town still looks to be the US, where we still have a relatively healthy, if lower, setting on growth than we did at the end of last year. We can see in the second half of last year, US growth was very strong, going back to levels unseen since 2022, and really marking a very stark departure from everything else that we see in the other two major economies. And of course, we know why these three, this is another chart that we keep going back to all the time. This is showing us that 58% of global GDP is just these three economies. China, the second largest, the Eurozone, the third, and the rest of world, largely vendors to the former three. That is to say, they don't have very much independent demand generation that they do. They depend on there being growth and demand in the US, in the Eurozone, and in China to generate the bulk of what they contribute to the global pie. So, with this in mind, here's where those three pillars of growth stand. Two of them are close to offline, or at the very least not going very far, and haven't been basically since the middle of last year, when they both sort of slumped to neutral and where they still hold. Whereas the US, again, although there's been a level shift in growth downward, still seems to be attempting to pull this whole apple cart all by itself. Now, that's well and good unless something untoward happens with US growth. And of course, what U.S. bond markets have been telling us, as we've been saying at length here, is that that's exactly what we're seeing. U.S. economic growth apparently in a situation where the markets anticipate some variety of slowdown, because we've seen that break-even inflation rates, taking us back to that conversation where growth and inflation go hand in hand because it is demand that pulls inflation. We find since the beginning of the year, break-even rates implied in 5 and 10-year U.S. Treasuries have fallen. And that was around the growth scare with the rollout of the Trump administration's tariff architecture. And while sentiment around that story has clearly improved, we can see the S&P 500 was falling with those break-even rates and now has clearly unwound those losses. The break-even rates remain near the lows. They continue to oscillate here at lower levels than they did at the start of the year. Now, that, of course, comports with this step down in U.S. growth and suggests that whatever is happening with U.S. economic activity, it's more so trending toward convergence with standstill in China and the Eurozone than the other two are trending toward convergence with U.S. growth. And this makes for a vulnerable environment because, of course, that means that the global economy as a whole is operating with no safety net, and China is in no position to be an offset if the U.S. economy missteps. Now, it's managing to hold it up for now, but as we look at what the bond market is signaling, as we look at the Fed funds futures contracts telling us that the Fed is going to do at least one, maybe two more rate cuts than they themselves, the central bank that is, have acknowledged, it's difficult not to perceive the risk that the markets are sniffing out some sort of economic slowdown in the U.S. And what the global backdrop shows us is, were that to happen, China isn't coming to help, and neither is Europe. And how you avoid a global recession in that scenario becomes difficult to imagine. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Victor Jones for The Price of Truth on Tuesdays, back with Chris for Futures Power Hour Fridays and Mondays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. Thanks very much for joining. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.